Kenvue, ticker symbol KVUE. Right now, we are putting this newly independent global consumer health giant through our proprietary earnings stress test. We need to see if its financials are truly built to last, or if, the structure is fundamentally flawed from the ground up. Welcome to this Iron Financial Explainer. This is the place where we forge a stronger portfolio, cut right through the broader market weakness, and build wealth that actually lasts. I'm your lead analyst, and my job is to inspect the raw numbers. We're talking the steel girders that hold up a company's entire financial structure, the revenue, the debt, and those critical operating margins. And with me, as always, is our resident market skeptic. They're the voice of the retail trader, here to demand absolute clarity, ask the really tough questions, and figure out if a stock is built on solid bedrock or if it's just a house of cards waiting for a strong breeze to collapse.
That's right, because it's way too easy to get caught up in the corporate hype, and I am here to make sure we're actually looking at the real foundation before anyone commits their capital.
So, let's grab our hard hats and dive straight into the blueprint, starting with a massive structural beam that management literally just dropped onto the construction site. Based on the Q1 2026 8K filing, Kenvue is reporting a staggering 47% jump in earnings per share. Alongside that, they're showing a 4.5% increase in overall sales. Now, for those of you who might be a little newer to reading the financial blueprints, earnings per share, or EPS, is essentially the raw profit a company makes divided by its outstanding shares. When earnings absolutely explode by 47%, but your top-line sales only inch up by about 4.5%, it usually means the company is aggressively slashing overhead, right? Laying off excess workers or buying back stock to artificially boost that bottom-line number. It shows that management is really wringing out the profits and pouring high-grade reinforced concrete. This is a heavy-duty statement that Kenvue is generating some serious bottom-line power as a newly independent entity.
Look, I hear the enthusiasm, and honestly, a 47% EPS jump sounds incredibly strong on a glossy corporate press release. But as a trader, I've seen this exact movie play out way too many times before. You can easily engineer your earnings per share through temporary cost-cutting and clever little accounting adjustments. A 4.5% sales increase is fine, sure, but it certainly doesn't scream hypergrowth to me. I really need to know what is actually happening underneath that shiny top-line number before I even think about committing a dime of my capital.
And that brings us directly to the core question for today's stress test. Is this 47% EPS jump a sign of actual, genuine structural strength, or is management just slapping a fresh coat of paint over a rapidly deteriorating asset? Think about it. Anyone can aggressively cut their marketing budgets or delay capital expenditures to make a single quarter look highly profitable. But doing that is exactly like skipping your mandatory building inspections or holding off on critical roof repairs just to save a few bucks today. You do that, and you're just going to face a catastrophic collapse tomorrow. When you are a standalone consumer health company, you absolutely have to prove that your operational integrity can withstand the elements quarter after quarter, year after year. So frankly, I'm not ready to buy into the hype until we pull out the magnifying glass and inspect the actual balance sheet to see the raw materials.
Fair enough. Let's look at the raw materials. The financial foundation, specifically when we look at the balance sheet comparing December 2025 to December 2024, it tells a very specific and I think strong story. The cash and cash equivalents are holding rock steady. They closed out 2025 with $1,062 million in cash, which is basically flat from the $1,070 million they held the year prior. That right there is a stable, reliable cash floor. It proves beyond a shadow of a doubt that Kenvue has the immediate liquidity on hand to operate day-to-day, pay down their debt obligations, and handle any localized economic volatility without breaking a sweat. Okay, hold on a second. Don't just stare at the cash reserves and call it a day. Look right below that at the trade receivables. This right here is where I see massive potential cracks forming in the foundation. Back in 2024, receivables were sitting at $2,165 million. But by the end of 2025, that number ballooned to $2,382 million. Receivables are essentially IOUs. It means Kenvue shipped the Tylenol and the Listerine out the door, but the pharmacies and the big box retailers haven't actually paid the bill yet. That is an increase of over $200 million in money that is legally owed to Kenvue, but hasn't actually been collected. When your receivables drastically outpace your sales growth like that, it means you're bleeding cash flow. It means your distributors are taking much longer to pay you. And if those accounts don't settle up, that 47% EPS jump isn't going to mean a single thing, because the cash isn't actually sitting inside the bank vault. Well, you have to view those rising receivables against their overall operational efficiency. The Q2 2025 specs show Kenvue operated with a 60.9% adjusted gross profit margin. Do you realize how heavy that is? In the consumer packaged goods sector, maintaining a gross margin north of 60% means you have immense pricing power. It means you can absorb raw material inflation, supply chain shocks, global currency headwinds, the whole shebang, and still churn out massive profitability on every single item you sell.
Yeah, but look at the right side of that comparison. Flat organic sales, 0% year-over-year organic growth. This is exactly what I am talking about. You have a 60.9% gross margin, which, yes, is fantastic, but you have absolutely no top-line revenue momentum to actually support it. They admitted in their own presentations that results were masked by customer inventory dynamics. For everyone listening, that is just corporate jargon for retailers bought way too much of our stuff last year, stuffed their warehouses full, and are still trying to sell it off their shelves before they even think about ordering a single new batch. If Kenvue is so immensely profitable, why aren't they growing their market share? You can't just rely on high profit margins forever. Eventually, a building needs more raw materials to expand outward. To me, this looks like a profitability streak completely lacking the necessary revenue growth to sustain it long term.
But they aren't just relying on margins. They are relying on structural pillars that have completely dominated the market for literally decades. Look at Tylenol. This isn't some trendy new startup brand hoping to catch a viral wave on social media. This is the heavy lifting of the entire self-care segment. Tylenol is a load-bearing pillar of Kenvue's entire portfolio. When money gets tight and the economy pulls back, people might skip the name brand cereal at the grocery store, right? Or maybe they cancel one of their streaming services. But they absolutely do not cheap out on medicine for their kids' fevers. When consumers go to the pharmacy, they don't gamble with generic alternatives when they are actually sick. They buy the brand they implicitly trust. Kenvue basically owns the over-the-counter space. This brand equity is the rebar inside the concrete. It's exactly what gives the company the pricing power needed to maintain those 60% margins even when broader market volume remains completely flat.
And hey, it is not just Tylenol either. The foundation is supported by an entire stable of household names across essential health and skin health. Nicorette is a prime example of this market dominance. This is a high-margin, consistent demand product that provides a continuous, incredibly reliable revenue stream. When you are evaluating Kenvue's standalone corporate structure post-spinoff, you absolutely have to factor in the sheer unyielding durability of these massive assets. Okay, I'll admit, having Tylenol, Band-Aid, Neutrogena, and Nicorette in your toolbox is a massive, almost unfair advantage. But the question still remains, are these legacy brands alone enough to carry the weight of an entire independent corporate structure? Think about it. When they were operating under Johnson & Johnson, they had the backing of a massive pharmaceutical and medical device empire to smooth out any rough quarters and provide a financial safety net. Now, that net is totally gone. They are entirely exposed to the wind shear of consumer spending patterns. If the global consumer pulls back even further, these brands take the hit directly, with absolutely nothing to cushion the blow.
Well, the historical earnings tape for 2025 actually proves they aren't just taking hits, they are actively deflecting them and consistently beating expectations. Kenvue has established a relentless, reliable pattern of clearing Wall Street's hurdles. Look at this. Q1 was a 9.09% beat. Q2 and Q3 were solid, steady beats around 3.5 to 3.7%. But then look at Q4, a massive 22.73% upside surprise. What we are seeing here is an acceleration of beats. They aren't just squeaking by the estimates, they are systematically outperforming them. This track record proves that their operational execution is getting sharper and that the analysts have been far, far too conservative in their financial modeling.
Okay, a 22% beat is impressive, I cannot deny that, but what it really shows me is that management is sandbagging expectations. They are intentionally guiding Wall Street analysts to lower their estimates so the company can easily step over a lowered bar and look like absolute heroes on earnings day. Beating estimates is a backward-looking metric. Wall Street is a forward-looking machine. The bar is now set much, much higher. The question isn't whether they beat last year, it's whether they can keep up this accelerated pace heading into the rest of 2026 without tripping over their own feet.
And let me just warn the day traders tuning in right now. If you think playing Kenvue's earnings is a safe, boring, blue-chip bet, you need to pay very close attention to this number, 5.75%. That is the historical average absolute move on day zero of their earnings release. At current prices around $17 to $18, a 5.75% move means this stock can easily swing a full dollar in either direction the exact second the market opens. If you have 1,000 shares, that is a $1,000 swing hitting your account balance instantly. This stock might sell soap and headache medicine, but let me tell you, it trades with violent volatility. We've seen single-day rips of 14% and steep, sudden declines. If you are stepping into this earnings event without a hard hat, this stock will whip around and stress test your portfolio to the absolute breaking point. The market reaction happens almost entirely on day zero, so if you are caught on the wrong side of the trade, you simply will not have time to evacuate.
That violent volatility is exactly why we rely on technical blueprints to map out our trades and protect our capital. The moving averages basically act as the physical floors and ceilings for the stock's price action. Right now, Kenvue has built a reinforced technical floor right around the 50-day moving average at $17.64. The 50-day moving average represents the short-term market sentiment. It's the immediate concrete floor holding us up. It has successfully reclaimed the 5-day, 10-day, and 20-day averages as well, proving there is really solid short-term support. However, we are bumping right up against a heavy, immovable steel ceiling, the 200-day moving average at $17.87. The 200-day is the long-term trend, acting as the ultimate resistance level right above our heads.
Meaning, we are trapped in a dangerously tight 23-cent box between that 50-day floor and the 200-day ceiling. The pressure is compacting big time. Whichever way this stock breaks on earnings day, it's going to be explosive. If it fails to break that 1787 ceiling, it's going to cascade right back down to the basement, dragging portfolios right down with it.
But the structural momentum is shifting dramatically in favor of the bulls. The bar chart technical opinion over the last week tells a really compelling story of recovery. Just last week, this stock was staring down a massive 56% sell signal. It was deeply oversold. But today, that has rapidly transitioned to merely an 8% sell signal. The selling pressure has completely exhausted itself. We are actually seeing a medium-term 50% buy signal start to flash green. This isn't a stock breaking down. This is a stock that is stabilized and poured a firm concrete base heading right into the earnings print.
A shift from a strong sell to a weak sell isn't exactly a roaring endorsement to go long, my friend. Technical stabilization is fine, but a chart can look absolutely beautiful on a computer screen, flashing green buy signals all day long. But you know what? Charts do not pay out dividends, and they certainly do not cover a massive $200 million spike in trade receivables. I demand fundamental proof. Until Kenvue actually delivers an earnings report that proves they can grow top-line organic sales while defending those margins, this technical shift is just a mirage in the desert.
Well, the options market completely disagrees with your pessimism. They are expecting a massive fundamental catalyst. The implied volatility heading into the May 8th expiration is sitting at an immense 42.81%. For those unfamiliar with the term, implied volatility is essentially the options market's internal fear and greed gauge. It measures exactly how wild traders expect the coming price swings to be. An IV of over 42% for a traditionally boring, slow-moving consumer staples stock like Kenvue is absolutely astronomical. It means market makers are pricing in extreme, violent price action. The boiler is running red hot. They know this earnings report is the crucial decision point, the exact moment where Kenvue either reclaims its long-term structural uptrend or gets heavily punished. And we can actually translate that fear gauge into actionable intelligence. The options market shows an expected move of 39 cents, or roughly 2.21%. That gives us a strictly defined mathematical trading range between $17.29 on the downside and $18.07 on the upside. Now, for sophisticated traders looking to build a resilient position, you can structure what is called an iron condor. This is essentially an advanced options strategy where you place strategic bets that the stock will stay trapped within this very tight 1729 to 1807 box. As long as the stock price doesn't break through those outer walls, you get to collect upfront cash, known as premium, just for providing liquidity, banking on the fact that the stock will stay contained within this expected technical blueprint. Market Skeptic. But notice that the top end of that expected range, 1807, finally breaks through that 200-day moving average ceiling of 1787 we talked about earlier. If Kenvue hits the top of that options range, it triggers a massive technical breakout. But on the flip side, if it drops to 1729, it shatters right through the 50-day floor. The options market is literally mapping out a make-or-break scenario for the stock's entire yearly trend.
And yet, despite all this technical tension, the analyst sentiment blueprint shows that institutional investors are just sitting on their hands. The consensus rating is a 3.15, which is strictly a hold. Out of 13 analysts covering the stock, we have exactly one strong buy and an overwhelming 12 holds. Wall Street is utterly terrified to put on a hard hat and commit their capital. They are staring at the flat organic sales and those rising receivables, and they have decided to stand safely on the sidelines to wait and see if Kenvue's operational momentum is actually real or just a complete fluke. See, you call it fear, I call it a massive structural opportunity. When 12 out of 13 analysts are stuck in a hold rating on a company that just posted a 47% EPS jump and a streak of consecutive earnings beats, it means the stock is historically underowned and deeply underappreciated. If Kenvue comes out and delivers a decisive beat with strong forward guidance, those 12 analysts are going to be forced to swallow their pride and upgrade the stock to a buy. And when that happens, wealth management funds and mutual funds that strictly follow analyst ratings are forced to buy the stock. That wave of mechanical upgrades creates massive institutional buying pressure. It acts as a structural crane, literally lifting the stock price higher purely on forced momentum. And even with that heavily cautious sentiment currently in place, the average price target on Wall Street is still $19.09. That proves there is undeniable upside room to build. Reaching $19.09 would cleanly shatter the 200-day moving average and represent a highly solid return for anyone buying near the technical floor today. It's a modest target, yes, for sure, but it reflects a realistic, achievable valuation for a company that is aggressively optimizing its daily operations. Modest is exactly the right word there. A target of $19.09 is barely $1 and change above current trading levels, so you really have to ask yourself, is capturing a roughly 8 to 10% upside really worth the structural risk of those customer inventory dynamics choking off forward revenue? Is it worth the risk that those massive unpaid receivables turn into bad debt that has to be completely written off the balance sheet? If the consumer weakens even further, or if inflation pressures crush their gross margins, this stock could easily retest its fundamental lows. You have to ask yourself if the risk-to-reward ratio here truly justifies putting your hard-earned capital on the line.
And that brings us to the final verdict of today's Iron Financial Explainer. We've inspected the blue points together. We've weighed the massive 47% EPS jump against the flat organic sales and analyzed the extreme compacted tension building in the options market. Kenvue undoubtedly has the legacy brands to do the heavy lifting, and they are definitely building a strong technical base right at the 50-day moving average. For me, the consistent acceleration of earnings beats shows that management knows exactly how to operate this heavy machinery. Market skeptic. And for me, the rising receivables, the total lack of organic sales growth, and the heavily cautious analyst sentiment are giant flashing red warning signs hanging right over the construction site. It might look cheap right now, but buying something because it is cheap for a reason is a very dangerous game to play with your portfolio. Lead analyst, so we leave the final decision to you. Does Kenvue have the structural integrity to be a load-bearing pillar in your portfolio, or is it just a beautifully painted value trap waiting to cave in? Cut through the weakness, trust the raw numbers, and forge a stronger portfolio. Keep your hard hats on, and we'll see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.